Hi everyone, so you want to see a quick trade done. As you know, with foreign exchange, even 1 minute charts, and here let me just tell you what I'm looking at. I'm looking at the FTSE 100 1 minute chart this morning. Even 1 minute charts can be well, it can take quite a while to get quite a few points under the table, but this has been a good one this morning. We've got just after 7 I got the buy signal. Let me explain how that works. As soon as the price moves above my blue line, I'll explain how those come up in a second. That's the buy entry. The exit occurred there as the price moved below the yellow line, the red cross showing us that we've got an exit. So that was exited at 64.44, got in around 64.24, so that was 20 odd points in from we're looking at 7:05 until 7:43. So in about call that about 40 minutes, 20 points. 20 points in 40 minutes. Now, depending on how much you're trading, will depend what kind of levels you're looking at. We've got another buy signal just happening live as I'm recording this. So basically, what is this that we're seeing on the screen? Well, those of you who will be familiar with the MT4 platform, it's a free trading platform. I clicked there for the 1 minute chart. I clicked here, so I'm looking at the FTSE 100. 7 a.m. is a good time to pretty look at the initial action on the FTSE 100 as the market just opens and people start getting a lot of the trades out of their system. So how did I get that buy signal? Well, followers of my System X will know that essentially what I'm looking at is the MACD being flat or rising in the 1 minute time frame and also in the 5 minute time frame, and then looking for a 2 period high. That can either be done visually by having the MACD come across as you can see there, and then looking at it across both time frames, but of course that means a lot of flicking back and forth, and then the 2 period high you've got to look at by eye, or say my algorithm just does that all for me, which makes life a lot easier. The exit is then when the MACD conditions that I just described are no longer working. So in other words, the MACD is either flat or falling in either of those time frames, and we would get a 2 period low for a 50% exit or a 3 period low for the next 50%. So sometimes you end up exiting the whole position if it's immediately just a 3 period low, as happened over there. We got that, and then I say we've got the market over there. Well, what does 20 odd points mean? Well, actually it's not 20 points. What happens is the market moves makes new highs relative to the preceding period, and like here, and we see it happening quite fast. Well, because that's just 1 minute. In 1 minute that moved quite a lot, and we see it rallying up. We add extra positions, and so what would tend to happen is your positions get added, but if it fails to make a new high in the next period, those additional positions you might take off. So you add an extra position there, you take off an extra position there, you get in there but you get out there. So some of those extra positions tend to capture some more of that 20% move. Now the reality is, for something like this, you might end up with an extra 5%, 5 points on the 20 points, so maybe an extra 25% bump up on what you had. So 5 out of those extra 20 pips that you got makes you 25 pips. Now if you're trading at say £10 a point, that's £250 in 40 minutes. If you're trading at £100 a point, obviously that's £2,500. Well, most people are going to be trading somewhere between £10 and £100 a point. How do you decide the amount you should be trading? As soon as you've got the entry over there, you've got a pretty good idea of what range typically this stuff is moving, and one way to do that is look at something called the ATR, the average true range. And that sort of tells you at that time that each one of these bars, 1 minute bars, that the market is moving around 5 points, 5 pips. If you put double that, so you put that in at 10 pips, that pretty much quickly tells you that your stop loss should be 10 pips below your entry, because 5 pips is just the noisy range that any one of these on average makes, as shown by the average true range, the ATR here. So double that gives you a stop loss. So assuming we entered at 64.24, your stop loss comes in at 64.14, somewhere down here, and that 10 pip loss should be 2% of your overall trading capital. Assume you've got I don't know, let's say £20,000 trading capital. This mathematics doesn't have to be done every time. You just do it. You get pretty quick at it. So let's say you've got £20,000 trading capital, and you say 20% of that, 2% of that is therefore £400. So those 10 pips have to equal £400. Therefore each pip has to be £40. So you know you're betting £40 a point. If you capture 25 pips, therefore at £40 a point, then you do 25 times 40, and that equals £1,000. And in actual fact, you've then made £1,000 in those 40 minutes, which isn't bad for 40 minutes work. Of course, you're going to get some of these where you're basically making nothing. You might lose a pip, maybe 40 quid or something, because it's gone flat. But essentially, that's how you're capturing in 40 minutes £1,000, and that's if you've got a £20,000 starting account, risk capital. So 1 minute FTSE charts, £1,000, £20,000 risk capital on a 1 minute chart, as I say, in 40 minutes. That's how it's done, and that was a 6-minute presentation.